So I imagine quite a few of you guys are investors. Some of you probably have your own family offices. Family offices and angel investors are playing an increasingly massive role in venture. Family offices are getting a much bigger bite of the venture capital pie these days, and you can see it on here. This last bar here is half a year in 2021, and that's during COVID. So this is on an exponential path up. We're going to see a lot more investing from family offices and from angels as part of venture. There is a problem with this, though, and that is that it's going to get increasingly hard to compete in a world where there's a lot of capital coming to it and a lot of technology. And we're going to talk a bit about that because this is really what Venture 3.0 is about. Because Venture 3.0 is going to change everything with respect to how people present their investment, how the investment gets analyzed, the time frame the investment gets done in, and pretty much everything about the way that people raise capital and people invest. But before we talk about 3.0, let's talk about Venture 1.0. This is the classic sort of movie version of venture capital. This is Silicon Valley. By the way, this picture is the first ever venture capital deal. This is ARDC investing in Digital Equipment Corp back when computer screens were round, as you can see in the middle here. And this deal probably took them a year to put together, God knows. And this was really the paradigm for the first 30 years of venture. Venture 1.0 was a boys' club based out of Silicon Valley that invested in proprietary deals and not many of them. This is what we think about when we think of venture today. It's a room full of folks. It's very much like this. It's a vibey environment with lots of people gathered around investing in young startups, people just out of university. Very, very collegiate sort of atmosphere where we all work together, we share deals, we share analysis, we share due diligence, and everyone's investing. Family offices, VCs, angels, everyone's in the group together. And it's a lot more efficient than it used to be. It takes less time to do a deal, and in some ways, you can kind of think of this as the golden age of venture capital because everything's kind of just perfect. We're all getting to have a look at a deal. We're all investing together. It's terrific. What could go wrong? Here's what could go wrong. So many of us would recall the 90s. At the very start of the 90s, you could go to your stockbroker and you could say, I want 20 shares or 200 shares or whatever the lot size was of Telstra. And they'd call you back in the afternoon, they'd process it. And by the end of the 90s, you had Goldman Sachs with tens of billions of dollars in dark pools, and the money was being invested and returned in a very, very different way, just in a 10-year period. We can see those same dynamics happening now in venture capital, and that's what I want to talk about and focus on today. Because if you're not aware of these dynamics, you will get bulldozed, you will get run over, because the kind of stuff that's happening right now is JP Morgan is lending Tiger Global $5 billion to invest in venture. Goldman Sachs and Sequoia are opening up open-ended funds where there's just limitless amounts of capital flooding in. So how do you compete as an investor, as a family office? How do you get your hands on those deals when people are starting to use massive amounts of technology, AI, and all sorts of things to really transform venture, I would argue, as much as Goldman Sachs transformed public securities trading in the 90s. So what we're going to focus on here is the movement between these two worlds of Venture 2.0 and Venture 3.0, and then we're going to talk about how we can compete and what kind of tools are available. So let's look at 2.0. So 2.0 can be summed up really as gut feel. You get a deal, you've got some time to look at it, you think about it, you talk about it with your spouse, you talk about it with your friends, but everything's very manual, it's very collegiate. You call up your other VC friends or your other angel friends and you talk to them about the deal. Everything's kind of local. There's this expression in America that you've probably heard of called TMZ, which stands for 30-mile zone. That's really the best description I can think of the way that American VCs have historically invested. They don't get on planes, they invest within 30 miles of their office, and nowhere is that more true than Silicon Valley. Everything they do is manual, all the DD is manual. There's a team of analysts sitting in their front office that are looking at the deals on the way in, and there's some special problems with that we'll talk about as well. Impact and ESG, who cares, is the 2.0 model. Nice to have. Yeah, there's some impact conferences out there. I'm not going to go to them. This was the thinking until quite recently. Co-investment rights and annual reports were really the norm for LPs in those funds. The LPs were very much passive, silent investors in these groups. Okay, let's roll to 3.0. 3.0 is a completely different paradigm for venture. Everything that used to be slow is fast. Everything that used to be manual is now automated. Things that used to be collegiate are now very competitive. And you've got people like Tiger that are flying into a city and scooping up the top 3, top 5 deals that they can in a particular sector without letting anyone else know that they're in town. Now, that's very, very competitive relative to what used to happen. They'd take 20% of the round, they'd give the other 80% to someone else. It's not happening anymore. They're taking the whole thing. And they're maybe investing at seed and taking every dollar available through to IPO. It's a very, very different strategy than what we've seen before. You're seeing a lot more use of AI and technology. As Hatcher Plus, we're one of the leading developers of AI and process automation technologies. We're going to talk a bit more about that in a second. But we see firsthand what all the other guys are doing, and it's really fascinating. And if you don't have access to AI and process automation, it's going to be very, very difficult to compete. Stage agnostic, what does that mean? It means that I don't care if it's seed stage or Series B or formation stage or Series C or pre-IPO. I'm going to go in and I'm going to invest. And it used to be that someone would come up to you at a party and say, hi, I'm a Series A investor. We don't think that's going to happen anymore or happen anywhere near as often. People will come up, they'll just be a venture investor, and they'll probably be investing seed through IPO. They'll be taking every dollar they can. In terms of real-time reporting and co-GP rights, what we're seeing now is exactly that. We're seeing people coming in saying, we want to get the right to invest beside you, not after you've invested. We want to be able to co-invest with you so we can put money to work. Our system that we've built, our VAST system at Hatcher, you can output a real-time nav on that any time of the day, anytime you want to, just by pushing a button. That's a lot different than what happens currently when you get your 6-monthly or 12-monthly report. So what does this all mean? Right now, I would say there's a handful of people that are using AI and process automation. There's some excellent systems out there. EQT in Germany springs to mind, the system I've talked about and we'll be talking about in a second at Hatcher. Also, some of the big guys have invested a lot in tech, and some of that's pretty good. But that's nothing compared to what Gartner is saying things are going to be like. They're saying that by 2025, 75% of VCs and investors will be using AI and process automation. So think back to that chart that we just had a second ago of the slow versus fast. If you're trying to compete and you're trying to get in on a deal and the other guys are using AI as part of their decision matrix, good luck. It's going to be very, very hard to get in on those deals if someone else is doing their competitive analysis in 10 seconds and you need 10 days. So this should be self-evident. If you want to compete in 2025 or even today, you need to get your own capabilities. You need to be plugging in your own AI, your own process automation. You need to have a system.